Hey everybody, welcome to the morning market briefing. Monday, May 2nd, 2022. Can't believe we're already in May, but here we are. A super busy week at a high level, Ben. I think we've seen obviously quite a bit of volatility, lots of market gyrations, if you will. I think my overarching goal for the week is to get some semblance of resolution on where we actually are. So let's start by talking a little bit about some of the economic data that we have coming out this week. Just to give you guys kind of the lay of the land, we're going to get ISM manufacturing today at 10. We're going to get JOLTS job openings tomorrow at 10. We're going to get ADP employment on Wednesday at 8:15. We will also get ISM services on Wednesday at 10 a.m. Thursday, we're going to get initial jobless claims as per usual at 8:30 in the morning, and we'll get the unemployment rate on Friday at 8:30 in the morning. There are other stories to talk about, but even just on the economic side, a pretty jam-packed week. Ben, from a narrative perspective, how would you position kind of a favorable week based on the data? Again, we're going to hear from the Fed, we're going to get earnings, but based on the data, what are you looking for? And don't just say good numbers.
I think what we want is continued strong employment numbers.
Strong numbers.
I would say I think that on the ISM manufacturing side and the ISM and services side, I wouldn't be surprised if we actually began to came in a little bit lighter than what the expectations are. And the reason is that it fits with where we are economically. Economically, right now, we are in a contraction mode. That's the most recent data that we got. We talked a lot about the GDP number on Friday. There's a blog post on our website that kind of contextualizes that. And I think that a lot of people have been quick to brush aside the negative GDP number because it's related to the net exports number being very weak. But what I would say is that the GDP number is the GDP number, and that was negative in Q1. And I wouldn't be surprised if it's negative again in Q2. And I think that that's where we are. Is it a full-on 2008 recession? No. Is it probably even 2001 recession? Probably not. Certainly not 2020. But there is a period of economic contraction. The positive is employment remains very strong. And I think that this will actually help to quell some of those fears of inflation. I think that what we're seeing is that a lot of companies, and we're going to talk about this a little bit later on, a lot of companies that performed extremely well during COVID really saw a lot of future demand pulled forward into that period of 2020 to 2021. If you look at Amazon as a perfect case in point, what we're seeing now is that those companies are falling back to trend. So whether you're GameStop and you did very well for a very brief period, and that trend was effectively to zero, you're going back to zero. If you're Amazon and your trend is 15 to 20% a year, you're going back to 15, 20%, which means that if you grew 40% last year, you're going to be flat to down this year. And that's just how it's going. And I think that as we motor on through that trend, we're seeing a contraction, but it's from a very high starting point. And importantly, employment is actually still on pace, and we're just starting to see things normalize. And I think the thing that people didn't really appreciate is that the new normal looks a lot like the old normal. And I think it looks a lot more like the old normal than a lot of people would have thought, which means that we're going back to trend. And that's not a bad thing.
Yeah, I think that's kind of I think we were in such a COVID brain mentality for so long that whether we are talking about investment themes, individual companies that are going to do well in quote unquote post-COVID life, whether we're talking about what employment data should look like, whether we're talking about raw economic data, very few people were willing to accept essentially, kind of this 18-month blip. And I understand that, and I appreciate that. And I think there are times where we question that. And I don't want any of this to sound condescending or like we nailed this whole thing. But it's abnormal to see a blip that lasts, 18 months, close to 2 years. And I think a lot of people were very hesitant to realize that ultimately we're going to kind of look back at this whole period. And if we just ignore the middle 18 months, you can build a pretty definitive trend of here's where we're going at the beginning of 2020, and here's where we are mid 2022. And it's going to make a lot of logical sense, in my opinion.
And you can still have, I think one of the issues that people have is if we have a contraction, that means employment is getting very bad and that there's going to be a very high unemployment rate. But you can have an economic contraction because if people spend less on whatever ad was just served on Instagram, whatever quick product that they have no other things to do other than just stare at their phone and buy stuff on Instagram or Amazon. And so that is contractionary, but that doesn't mean employment's really bad. And I think that those are two things that are held in tension, that is uncomfortable. But I think if they can continue to be held in tension, we get through this trend, employment is still strong, and inflation comes down a bit, I think we're in a good spot.
I mean, in some regards, this is, in my opinion, I'll throw it to Tom on economic data here in a moment, but in some regards, this is kind of the hangover effect of what we talked about a lot last year. And I think the single most unbelievable data point of 2020, the COVID peak year, so to speak, was the fact that median household income went up. If you have more people not working, you have people with prolonged periods in which they're locked in, they're not going to work, they're not going out and about, but income went up, you're going to have by nature some discretionary purchases that are not normal. And so in a lot of regards, the theme that you just kind of touched on, that employment can remain strong, but people can spend less on frivolous items, it's kind of to be expected to some extent. Tom, on the economic data, what are you looking at this week?
I mean, the jobs number is definitely going to be interesting because we're going to see if there's been any knock-on effects of the original rate hike. I think this will be really the first true jobs report where we'll start to see that trickle through. I mean, obviously, the Fed raising rates on Wednesday, what is that going to look like is going to be a big piece, and we'll get into that next. But I think, yeah, to you guys, to your point, I think what happened was the Fed essentially said, if the economy is a fire, this thing's going to go out. And so we're going to put gasoline on it and throw every log we can in there. But the problem is eventually we ran out of logs, so we maybe used 2 or 3 years worth of logs. Now we're going to go chop some new ones, and it might take us a little bit of time. It might be cold for a couple of weeks, just until we get some more logs for the fire. But I mean, it burned super hot, and they were very clear that's what they were going to do. But the problem is we've run out of fuel. We pulled so many years of fuel, put it in the fire. Now we're running a little bit low on wood. I think that's kind of a good way to think about it.
Yeah, I like that. Big log guy. The Fed Wednesday, we're going to hear from them. I think the general expectation, and rightfully so, is that we get a 50 bip rate hike. We also are paying attention to how they actually let the balance sheet run off. Tom, as we sit here, I mean, it's an interesting time because we're going to have so much data coming out shortly thereafter. But what do you think the course of action here is at a high level, and what are you looking for?
I don't think it's in the Fed's best interest, given how volatile the markets are, to surprise one way or the other. I think 50 basis points is going to be the number for this month. And I think then they go forward and set the table for 75 bips next month. If you look at the current layout of what futures are saying, it looks like right now there's about a 7% chance of a triple rate hike on Wednesday. So I think that's pretty unlikely, but we're inching up closer to 40% for June for a triple rate hike. And so that's, I think the path they're going to take, and I think they're going to get aggressive on the front end. I think they probably should have been more aggressive earlier, but I think the Ukraine situation really threw a wrench in their plans. But I think that the way they can be more aggressive without doing additional hikes is to be more aggressive with the runoff on the balance sheet. And so I think that's really if we're going to get a hawkish signal, I think it's going to be on the runoff. But they're set to lay out how they're going to start unwinding the Fed balance sheet, where they're going to place money and where they're not going to place money. But my expectation is that they're going to continue to sell off mortgage backs. And I think that that's going to be a really tough area for the foreseeable future. I mean, not that all bonds aren't at this point in time, but mortgage backs, I think, are just going to be just terrible because they're going to be actively selling against the market. Rates are going to be going up naturally. And the housing market seems to be at a point where people aren't really excited to buy in at these rates. And so I think that's going to be the real loser in all of this, I think, is going to be the 30-year fixed mortgage. But I guess we'll see how they lay that out. They may say, hey, maybe rates are too high on mortgages. We're going to shift it a little bit closer towards treasuries and really hurt the bond market in general versus just mortgage backs. But I think that, they can really slow things down. They can really tighten demand in the market by hurting mortgage-backed securities and pushing rates up. And I think that's probably the way they're going to go.
When do the buyers come in? At what point? Because the spreads are exceedingly wide between mortgage-backed securities and treasuries, historically wide as they were in 2020, as wide as they were really at any time. It seems to me that a pension fund at 5.5%, lock in some of those returns. And yeah, you have extension risk on them, but you're in at 5.5%.
I think that the coupons are going to be the linchpin there, because if you look around at the mortgage-backed market, there are no coupons over 4%, and there just haven't been for years and years and years. I mean, that just isn't there were no issuance there, and so once we start to see those coupons tick up, even if they think they're going to underperform, locking in for 30 years at 5.5%, but we're not quite there yet. If you've got decent credit, you're probably still slightly under 5, but I think that's going to go away in the next couple of weeks, at which point I think we see the spreads tighten, but I still think that it's going to be a losing proposition. I think we're still going to see higher interest rates towards the end of the year, but you can lock into those numbers, you might as well.
Tom, we've talked a lot about, kind of our house view that the Fed was probably 6 to 9 months slow to act. Had they acted earlier, do you think we would have seen, let's just say hypothetically that the Fed moved 9 months earlier? Would we now be in month 9 of 30-year mortgages being in excess of 5%, or do you think they could have controlled that a little better?
I think it would have gone slower. Think about what happened in the last, call it 9 months. We had an unbelievable run up into the end of the year. The stock market was just on fire heading into December. And then the Fed decided to act. As soon as Jay Powell was confirmed, January, boom, we're tightening. And we saw all of that come back. I think instead of having that big run up and run down, it probably would have been a much more gradual. Even if we were flat, it would feel a lot better than if we had gone all the way up and come all the way down. And I think that would be the difference. It's less of a volatility play and more of even if we just treaded water from last year to this year, it would feel a lot better in people's minds, because we wouldn't have reached those heights, towards the end of the year. I think it would have been much slower. And I think the rates would have gone up in a more controlled manner, because they were so low, back in August or so, when all of this stuff really should have started happening. I think it would have been a little bit more of a gradual hike in rates. It would have been less painful, and it would have given us a little bit more time to be, stepping into bonds over time, as opposed to everything we own getting discounted and then having to replace with new higher bonds.
I want to switch gears a little bit. We've still got a lot of earnings coming through this week. Ben, I think you were spot on in terms of returning to trend. We're seeing that even on a company by company level, as some COVID gains that we saw from certain folks like PayPal, Amazon, others are really kind of going back to where they were headed initially. Before we jump into kind of the preview of the week, if you were to kind of grade earnings thus far this quarter relative to your expectation, and not just earnings, but also commentary, guidance, all of those things, how would you kind of mark this one?
I'd say a B. I think that there are definitely, but you're bifurcated. So you have some companies that are performing very well. No company is really shocking me to the upside. There have been a couple of companies that are surprisingly bad. Think Bed Bath & Beyond, for example. Amazon didn't really shock me to the downside. It was actually relatively close to my expectations in terms of e-commerce underperforming a little bit, Amazon Web Services performing well. I think Apple had a really good quarter. Their commentary was fairly dour relative to expectations. I think a lot of it makes a whole lot of sense. I was actually really positive on a lot of the transports that performed fairly well. And the airlines did quite well, as also really seeing a resumption of business travel. But we'd kind of been expecting a resumption of that coming into the quarter. So overall, relatively as expected. Just you're not seeing any big blowout on the top side, and there's been a couple that have underperformed.
Good deal. Busy week. Lots coming through. Maybe not quite the big name value that we had last week with so many massive companies and large holdings and client portfolios coming out. But take us through kind of the schedule and who you're looking forward to hearing from.
Yeah. So this evening we have Expedia. So that'll be, again, a good read on what travel demand is looking like. By all accounts and purposes, it's performing extremely well. You have Pfizer tomorrow morning. Pfizer is going to be a very interesting one. Merck took down its COVID-related guidance for the year. Thermo Fisher basically removed all of its COVID guidance for the year. So I am very curious as to see whether Pfizer reiterates, because about 50% of its revenue is expected to come from COVID vaccines and COVID treatments this year. So that's going to be a huge question mark as we get into tomorrow morning. So we'll be able to talk about that on the call. In the evening tomorrow, we also have Starbucks. This push toward unionization at Starbucks and at Amazon and some others is something that continues to bear watching. I'm interested to see what the new CEO has to say on that. Wednesday morning, we have Vulcan Materials, which will give us some good commentary on the aggregate space. And then Thursday and Friday, it begins to cool off and the focus shifts a little bit more to the Federal Reserve and economic data, but we still have Under Armour reporting on Friday morning. So there's a lot going on this week. Again, it's not as focused on earnings this week as it was last week. I think you're going to see the baton pass a little bit more toward the economic data and especially the Federal Reserve. And that's especially as we get Wednesday, Thursday, and Friday of this week.
Awesome. Thanks, Ben. Thanks, Tom. Reminder, check out the blog. I think the blog post on the GDP print was really helpful to kind of contextualize things. So if you haven't read it, just go to Narwhal Capital. You can go to the Insights tab and it's got the blog on there. So check that out. We will be back tomorrow morning at 8:30. Hope you guys have a great day and a great week.